Thank you for joining the Berkshire Hathaway 2019 Insights webinar. We're going to talk about how to use insights from Warren Buffett and Charlie Munger to make better investing decisions. So the intrinsic value approach used by Buffett to become the best investor in the world has been successfully used by many other investors to achieve good long returns. People, I think, sometimes misunderstand or misapply what Buffett says to their own investing. So we're going to dispel some of those misconceptions. And finally, at the end, I'm going to tell you about a story that Buffett has mentioned in a private interview that I think might change how you understand his investing approach. So make sure to stick around. So with that, let's get going. So briefly about me, my name is Gary Mishuris. I'm the managing partner and chief investment officer of Silver Ring Value Partners. I also teach the value investing seminar at the FW Olin Graduate School of Business. So not that interesting, so I'll keep moving along. Silver Ring Value Partners is a partnership that I started around 3 years ago because I really didn't think I could get the alignment that I wanted, alignment of interests, working in a large company. And I'd worked at the large company or various large companies for 15 years prior to starting. So that was really the primary reason I wanted to go on my own. My competitive advantage, it's a combination of things. It's long-term time horizon, it's microeconomic focus, it's an intentionally limited asset base. And as we'll talk about, I think temperament is really important, and having the right temperament, especially under conditions of adversity, is a really key thing. I'm not going to talk too much again about what I do because I want to switch gears to Berkshire, but my investing philosophy, it's an intrinsic value approach using a margin of safety that I believe comes from a combination of the quality of what I buy as well as a big discount to conservative appraisal of the intrinsic value offered by the price, with a long-term approach that results in a concentrated portfolio. Anyway, enough about me. Let's talk about Berkshire. So, I think Berkshire is, an interesting, company. It's certainly, Warren Buffett and Charlie Munger are probably two of the best, if not the best known investors in the world. And they offer a lot for us to learn from and apply to our own investing. And so I think I wanted to start out by talking about how do we learn from Buffett and Munger? And I think the way you don't want to go about it is you don't want to do just blind imitation, nor do you want to do kind of blind hero worship, if you will. And the reason is that I don't think that's the best way to apply it to your own circumstances. Charlie Munger is a big believer in cross-disciplinary mental models, and I think that I want to kind of borrow one from my childhood pursuit of chess, where if you're serious about chess, after you study the theory and you practice by playing, the way you really progress as a player is you study grandmaster and master games. And you study them not just to memorize what move someone played at some point, because that specific situation is not really going to reoccur for you, but instead you're trying to understand things from first principles. So you're trying to ask yourself, like, why did the master make this move here? And what does that mean for how I want to behave in a similar situation? So I think that's the way you want to learn. Now, I think if you think about it, there should be 3 steps. One is you want to understand what Buffett and Munger are saying and why they're saying it. You want to apply, what they're doing in practice, because investing ultimately is not a speculative sport. You need to practice, and practice. I've done this for now 18 years professionally, and I'm still learning every day. And finally, and I think this is an important step, you need to customize. I think that too many people, study Buffett almost religiously, as if he is some prophet where, they're trying to discern the meaning of every word. That's the wrong approach. I think the right approach is understand why he's doing and how it applies to your situation, and then to think about your own strengths and weaknesses, your own circumstances. Because you know what? I'm not Warren Buffett. You're not Warren Buffett. And you have constraints and you have things that are going to cause potentially different answers than might be right for Buffett. So again, I think you want to really customize to your own circumstances. So what I'm going to do is, as I listened to the meeting, there were 5 themes that stood out to me. I'm going to go through them and we'll talk about them. I would love your participation. So the way I'm going to do the participation based on the feedback from the last seminar is at the end of each theme, I'm going to pause and see, if there are any questions or comments or anything really relating to what we just talked about. And if there are, I'll read them out loud so everyone can hear them, and I'll give you my thoughts and whatnot if it's a question or a feedback. If there are other questions, that are unrelated to this particular theme, by all means, please put it in the chat, and I will get to that at the end. So I'm happy to do my best to answer anything I can, but I want to kind of stay on topic as we're talking through these themes. So the first theme that I want to kind of touch on is, what is value investing? And it sounds like a pretty, stupid question. Like, what do you mean? What's value investing? But I think in recent years, you've had a lot of debate. You've had many practitioners of value investing evolve in their minds to an approach that is far less sensitive to price and valuation. And it's much more sensitive to quality and growth. And they think of themselves as evolving to a higher level of, practicing the art of investing. And they kind of almost look down on the poor, mere mortals who are still waiting for, cheap securities. And their thought is, look, statistical cheapness is kind of nice, but really what you want is a business that's growing in value over a long period of time, managed by great people with a great balance sheet. And if you find that, price is kind of nice to know, but not going to be the biggest determinant of your results. And they frequently point to other good investors like Charlie Munger and his ownership in Costco and so forth. And so I think that there is that trend, and I think some of that trend is genuine evolution. I think people are improving. Some of it, I think, honestly, is, even though I think these people don't think of it that way, there's them succumbing to the fear of missing out. Day in, day out, they watch growth stocks go up and value stocks, quote unquote, because there is no such thing, I think, in general, but slower growth, more mature companies not go up nearly as much. And at some point, the pain gets too much and they evolve to paying up. So I think for some it's genuine evolution. For some, I think it's loss of discipline, and time will tell which one. But I think it is interesting that Buffett kind of weighs in on this. And so I'll read the first quote on this slide by Buffett. And again, this is my best recollection, so the words might not be exactly one for one, but I believe I captured the gist of what he's saying. So Warren Buffett said, the decision to buy Amazon stock was just as much based on value investing principles as a decision to buy a statistically cheap stock. Value investing is about estimating and valuing future cash flows, not about how low a price to book or price to earnings ratio is for a stock. And by the way, just for clarity, for those of you who don't know, it's not Buffett who bought Amazon. It's one of his lieutenants, either Todd or Ted, I don't know which one, but he's explaining kind of, hey, these guys style drifting was kind of the question. And he's saying, well, no, value investing is not about multiples or statistical cheapness. It's about comparing price and intrinsic value. So I think that that's important. And then there's another quote later on in the meeting, and again, I'll read it verbatim. You can pay too much for a wonderful business. There is a price where we would have paid too much for See's candies, and it wouldn't have worked out well as an investment. You can turn any investment into a bad deal by paying too much. And I'm going to repeat this. This is my emphasis. You can turn any investment into a bad deal by paying too much. What you can't do is turn any investment into a good deal by paying a cheap price. So I think that this is important because, so here, here's one of his lieutenants. His, presumably he thinks he's one of the top, investors in the world. He hired this person to be kind of his, successor eventually in the investing side. And, they're buying Amazon. And by the way, it's not wrong to buy Amazon just because the stock is up a lot. I think that's a behavioral bias to say, well, the stock is up a lot, so I shouldn't buy it. The question really, I think, is, I think the question really is there an intrinsic value estimate that you're comfortable with that's within your circle of competence? And I think that essentially you have Buffett here saying, well, for me, it's outside of my circle of competence. And because he's not buying Amazon, and he's instead, what he's doing is he recently structured a deal where Berkshire is going to finance Occidental Petroleum by buying a 8% preferred and also getting a warrant. And my best estimate is that essentially it's a low teens IRR is pretty safe bet that he's going to get from this transaction. So here's Buffett, while everyone is trying to figure out should they buy, which of the FANG stocks they should buy, he's saying, you know what, thanks but no thanks. I recognize that it could fall within the purview of value investing, but for me, it's outside of my circle of competence, and I'm going to stick with a high probability, low teens IRR, but I'm not going to bet on these companies where you really do need to know the future 15, 20 minutes, 15, 20 minutes, 15, 20 years into the future to really have a differentiated view. So I think that's an important point that I wanted to cover, because I think that we don't know the answer. And my view is there is no one answer, and this is where customizing is important. I think that what you want to do is you want to think about, is something like an Amazon or whatever company is at the price you're thinking about buying it, is it something that you want to go ahead and invest in based on your own strengths and weaknesses? For me, I'm not really comfortable doing that because it's not something that I think is within my circle of competence, but I don't think of investors who choose to do so. Basically, I think that it's fine if they think they are capable of doing that, but I don't think that it's me. So I think that that's the right approach, is not worrying about is something value investing or not, or is something basically value investing or not. So don't worry about labels. Worry about, from first principles, is this a good investment based on that idea of intrinsic value based on your own approach. So let me pause here, see what comments, questions you have on this topic. And again, please use the chat, and I'm going to pause for just 10 seconds to see if anyone wants to have a comment, question, agree, disagree. Anything is welcome. All right, so I'm going to keep going. And again, if you come up with questions on this, they're happy to basically follow up towards the end of the Q&A portion. So all right, so let's move on to theme number 2, and I think it's the basics of business quality. And here I'm going to start with a quote from Charlie Munger. And this is not actually from the meeting, but this is from an interview that he did with Wall Street Journal's Jason Zweig. And I think it's interesting. And so here's the quote: "If you take the 100 biggest corporations in the United States in, say, 1900, there's exactly one left alive, meaning among the list of today's 100 biggest. But that turnover on the list didn't happen because everything got so weak. It happened because the competition and the change got so strong." So that's interesting, right? Business mortality, is fairly, high, right? And there's another, kind of related point by Warren Buffett during the meeting. So Warren Buffett said, "It is possible that the new technology platform companies will prove to have durable moats, but we have had trouble thinking through their future economics. We can understand their business now, but less so how they will evolve. We have tried to mitigate that by hiring people who understand these business models better, like Ted and Todd, and by trying to widen our circle of competence. However, we are very comfortable missing out on big returns as long as we have a good batting average on the investments that we do make." So I think that this is an important point, right? I think that people forget how many once dominant businesses are now not really dominant at all, or are gone. GE, Sears, Kodak, Dell, many businesses. And I think, I was talking with a friend, and we were talking about these technology companies, the platforms, and he was saying, like, I can't see anything on the horizon that could possibly make them bad businesses. They were saying, hey, like, what can you point to, Gary, that would make Google or Facebook or Amazon, not grow at the rates that we think they're going to grow at? And here's the thing: I don't know anything specific, but you know what? If you were analyzing Kodak in the 1960s or whatnot, or Polaroid, you might not be able to point to anything either, meaning that you might not have been able to say what's gonna upset the apple cart. Or if you were analyzing Sears, would you really be able to predict the rise of Amazon down the road? The point is not that there is some specific threat we can identify, but really that there are unknown unknowns, and businesses change. And I think the current period is probably the close to, it's not the same, nothing ever is the same, but it is the closest to, in my mind, Nifty 50, kind of the 1960s era, where there were these powerful companies and their business models were considered so strong that essentially, they were unstoppable, and there were one decision stocks. You buy them and you hold them and you never sell. And I don't think it worked out that well. I mean, there's some debate because someone pointed out that Walmart was in that group and it did well. But as a group, if you try to hold those group of stocks and normally manage portfolio where you wouldn't let one company become half the portfolio or something like that, you would not have beaten the market with that approach. So I think it's important to think about business quality not just with respect to what's visible today or what's analyzable today, but with understanding that the pace of change is fairly quick, and that there might be changes, be it competitive or technological or regulatory, that might change the business. I think the other point that Buffett has mentioned both of the last two annual meetings is that the durability of competitive advantages, so the durability of moats, as he calls them, is much more fragile, and the pace of change is basically much faster. So I think it's that much more important to guard against negative change, which is, by the way, that's the Benjamin Graham classical value approach, is to guard against adverse change to the business because you're relying on the future being similar to the past. And if you are one of the investors who are comfortable betting on rapidly growing companies at high valuations, then you're hoping that these companies are the ones that are going to be able to adapt better, and that they have management teams that are nimble enough that can change with the changing times. So I think that I think business quality is more important now than ever, because I think you need to understand what makes a business predictable, what's going to keep the economic characteristics good for a period of time, hopefully for a long period of time. And I think that the pace of change picking up makes business analysis more important, not less. And in that I agree with Buffett, and I agree with people who have been shifting their focus away from security analysis to business analysis, because I think that security analysis is not hard. It's business analysis that's hard. That doesn't mean that security analysis is not necessary. Once you analyze the business, you still definitely need to understand the security. But nonetheless, I think the business quality analysis is becoming more and more important. So let me pause here. See any questions? I see that there's some questions from the first theme. So let me try to catch up on those for a second, and type in any questions you have on the second one. And so let's see here. So we have a question. So theme one thought: there's a very thin line between A, paying a quote reasonable price for a very good company, and B, ruining the good investment idea by paying too much. Would you agree? So I do agree. So Daniel, thank you for the question. So I do agree with that. I think very recently we saw Buffett learn that lesson the hard way on Kraft Heinz. And his point is that Kraft Heinz is still a very good company. Its return on tangible assets is still extremely high. And so it's not that basically, it's become a bad business. It's not that. It's just that it wasn't quite as good business as he thought when he underwrote the investment. And so what happened was he ended up, paying too much, and the business is not doing quite as well as he thought it would do, and he lost billions of dollars. So price always matters, even for the best businesses. I think, what's a reasonable price? And I'll tell you a story about what Buffett thinks about his quote-unquote reasonable price at the end. But I think you need to have a big margin of safety. And margin of safety essentially means that things can go wrong and your investment still does well, or at least doesn't lose you a lot of money. So if you underwrite investments where you have to be right on very high future rates of growth, and the growth turns out to be not quite as exciting, you can lose a lot of money. So that's where I get uncomfortable. Again, but someone else might say, hey, I want to bet with the Google guys or the Amazon guys because they're able to figure out the changing landscape, and I'm embracing change and I'm betting on their team that's going to take advantage of change for the better. So there are different approaches, but I think that if you want to pay a very low price in relation to business value, because business value ultimately is an estimate, and you're going to be wrong. And when you're wrong, you want that margin of safety. All right, so I'm going to move on to the next theme. Keep the questions coming. Really appreciate them. All right, so I think the next theme is theme number 3 is behavioral biases. And I have a couple of Charlie Munger quotes. The first one is, it's hard to be reasonable. there are a million tricks the human mind plays on its owner. That's what causes stupidity. Think of how many times you've said to yourself, why in the hell did I do that? And then the second quote, also from Charlie Munger, is both Warren and I feel it's our moral duty to be as rational as we can possibly be. A lot of people who are brilliant in some ways tend to make these utterly asinine decisions in other ways. We tend to collect the asininities, sorry if I'm butchering that, of the world in a kind of a checklist, and we try to avoid everything on that checklist. So I think that that's a key point. So I think a lot of people think investing is tough because of, hard to value a business or a technical aspect of it or something like that. And I think those are challenges, and that's fair. I think the biggest challenge that I see in investing is behavioral, because at a certain level, of competence, almost anyone can roughly value a business. Almost anyone can, assess a company. I mean, and there are some differences in skill, of course, but I genuinely believe that it's really temperament, and that it's the behavioral differences between people that are going to set them apart. And here's what I mean. There are two types of things. One is temperament. And by temperament, what I really mean is you have your process, whatever your best process is, and hopefully you have a process. And the question is, can you stick to that process under conditions of adversity? So if you can't, then it doesn't matter how good your process is, because you're not sticking with it, right? And usually every investor is going to have patches of bad performance whether it's they're investing their own capital or other people's money, they're going through a rough patch. The only one who didn't have that was Bernie Madoff, and we know how that turned out. So everyone else who's a real human being is going to have a period of time where their approach is not being valued by the market, even if they're doing a great job. So can you stick to your process when that time comes for you? Very important. So the second part is behavioral biases. And what I mean by that is, so you have various, anchoring, overconfidence, confirmation bias, ignoring base rates, all these things that cause us to make less than better decisions. For instance, we all think we're above average. Some of us are, some of us are not, right? But for instance, again, confirmation bias, we are very eager to focus on information that agrees with us, right, and ignore information that goes against our thesis. So I think Munger's approach of a checklist is very important. You really want to understand kind of all these biases, and you want to have a systematic way of guarding against them. And I'll tell you, one way I've done it is I've started the Devil's Advocate Club, where it's a small group of competent value investors who help each other out by acting as a debiasing kind of agent, where, say, one person submits a company and says, well, can you present a strong opposite point of view of why this is, say, a bad investment? Not just opposite by inverting it, but really focusing on all the negative aspects of the investment situation. So the point of that is to seek out the opposing point of view and have a strong argument, thoughtfully made after serious work done to try to de-anchor someone, debias them, and so forth. But there are other checklists, and I think I really encourage you to build your own. And the best way to do this is you want to study both your own mistakes and mistakes of others, because if you just start your own mistakes, it's going to take you too long. But you definitely want to study common mistakes and study failure, both business failure and investing failure, and understand what hasn't worked, where errors of judgment occurred, and use it as a checklist for future decisions. So let me pause there, see if you guys have any comments, questions, feedback. And again, please type it in the chat if you do. Otherwise, I'll move on to the next theme. All right. Well, if you think of anything, definitely, you can still ask it, and I'll answer it at a later point. So I'll move on to the next theme, and that's theme number 4, and it's the business of investment management. So Buffett gets asked a lot, almost every meeting I've been to. So I started going to Berkshire Hathaway in 2001. So I've heard a lot of these. So Buffett talks about all this stuff, and inevitably someone says, hey, I want to manage other people's money, how do I do it? Or if you were only managing a small amount of capital, how would you invest it? And all of that, all of that stuff. So I think that he got asked that again, and there were a couple of things that stood out. So the first quote is by Buffett, and he said, you should only invest other people's money if you can have the kind of investors who will stick with you for the long term and not panic and withdraw funds during rough patches in the market. I think that's super important. So when I started the partnership, I literally have a checklist I have for potential investors. And that's not because, you know, I'm high and mighty, nor do I give them the checklist, but I really am willing to turn people away regardless of how much money they bring, because I'm going to go through periods where, on a mark-to-market basis, my portfolio is doing worse than the market, right? It's going to happen and always will, right? So you don't want people who are reacting to irrelevant short-term performance and investing or not investing based on that. They're going to essentially put pressure on you to shorten your time horizon where you can't be a long-term investor anymore. You really want the kind of partners, and I'm fortunate to have those kind of partners who, when you say, listen, I'm going to tell you that right now the portfolio is very attractive, and you should be adding capital if you have it. But the results in the short term aren't particularly good. I think that you should basically, be giving you money. You want those people, if they can, they're willing to give you money, not say, well, your last 6 months have been X, Y, and Z, and therefore I don't like you anymore, right? You really, those people you shouldn't let in at all, right? So you need to be able to attract the right partners. An interesting point from Charlie Munger, and I'll read his quote, is, I have seen genius after genius with a good record, and pretty soon they have 30 billion under management and 2 floors of young men working for them. And away goes the good record. And this is just a very profound statement that in this business, and especially in fundamental equity investing, but in most investing approaches, other than maybe global macro trading or something like that, the business has very different economics of scale for the clients versus for the management firm. For a management firm, the costs are fixed. And I worked for many very large firms in the past, and the drive is always the same: gather more assets. There's no bad assets. Gather assets, gather assets, gather assets, and you'll tell some story about why it's okay. We've hired more analysts. We have more robust systems. We have a new strategy, and so forth and so on. All of that is just rationalization to justify gathering more and more money. And the reason it's so profitable is the costs are fixed, and the management company starts making so much money. It's like a drug. It's hard to stop. On the other hand, from an investor's point of view, the original investor, say the person who gave you your first, was there with you day one, beyond a certain point, it actually really hurts their returns for you to keep gathering assets. But I've almost never met someone who has the ability to stop taking additional assets while the money is still coming in at a relatively small scale, and they just say, nope, I'm going to close. And I think the ability to do that, and this is something that I strongly believe in, is really important, because returns are going to really get competed away. And there's just so much data out there about how, basically large, funds, don't do nearly as well over time. So it's nearly impossible, I think, to generate meaningful excess return. By meaningful, I mean 4 or 5% per year or more, investing tens of billions of dollars in large cap strategy in the U.S. Just the markets are too efficient. So I think that one other thing I'll mention is, so in the past, Buffett said that if he were managing just $1 million, he was pretty sure he could generate a 50% annualized rate of return. And he was asked about that, what kind of strategy would it be, right? We would all like to know. I would like to know. And he basically said it would be an arbitrage strategy that would only work with 1 million. That wouldn't work for, say, 100 million, which is still a tiny amount compared to what he's managing. So I think that returns do fall off quite quickly, but I think in the hands of a skilled practitioner, you can invest a small amount of money much better than a large one. So let me pause to see if any questions. And I think there's a question on the previous part from Lewis. And Lewis was asking, can you please give more details on temperament? So, temperament, is basically like, so when let's say you make an investment and it goes against you. Let's say the stock drops, quite a bit. And I'll tell you a story from my early days in Fidelity. I started as a young analyst at Fidelity 18 years ago, and one of my earliest recommendations, the company pronounced horrible result right before Christmas Eve, and suspended its dividend, and the stock opened down 50%. So, and we owned over $100 million, which for Fidelity wasn't a lot, but for a young analyst who was recommending we do so, it's quite a bit of money. I left MIT with negative net worth, so 100 million, and having that 100 million go to 50 was kind of like getting sucker punched, right? So you feel almost physically sick. And so the question is, what do you do? It feels awful, right? Maybe you're wrong, maybe you're not wrong, but all you can think about is, oh my gosh, based on my decision, this money, was committed, and now it looks like maybe it's lost forever, or maybe not. But you have a visceral reaction, and you have two very different choices. One is you can go and cry under your desk, and by the way, you feel like you do want to go cry under your desk. It's not a happy occasion. Or you kind of deal with that feeling and are still able to react to information, respond rationally. And rationally would be, okay, what's changed? How has my value for the business changed? How does that compare to the new price? And what's the right decision going forward? So over time, I've had a number of friends, I don't want to single anyone out, or certainly not by name, that are in the cry under the desk category, where I will get they'll be like, oh my gosh, I'm doing really poorly this year. What do I do? Or this stock, it's going down. I don't know what to do. And I always say, well, what's your process? And do that. And then over time, if you want to improve your process, sure. But at this point in time in the crisis, fall back on your process. It's rigorous. It's there exactly for this reason. So I think temperament is being able to stick to your process when your mind is screaming at you to do something different. It just gets overwhelmed with fear or with greed and just overwhelmed with emotion. So you want to be rational and not emotional in your decisions. So there was another question, I think, or comment from Max Rudolph. So many really smart people think that they can add leverage and do even better. Buffett and Munger always talk about the dangers of leverage. So this was addressed, a little bit, and I think that leverage. There are different kinds of leverage, right? So the kind of leverage that Buffett and Munger have at Berkshire is very good leverage for the following reason. It's non-recourse, and by the way, they have leverage through float, right? So they are levered, but it's the kind of leverage that they can't get a margin call tomorrow if their stock portfolio goes down. So it's very, very different from some hedge fund deciding they're going to borrow against their securities. The bank, uses the securities as collateral. It's recourse leverage to the portfolio, and then all of a sudden, the stocks fall, and the bank comes calling and says, "Hey, I want my money back." And you say, "Well, but I don't want to sell my securities; they're so cheap." And the bank says, "Well, I don't really care. Look, here's a contract with you. It says that the market value of a collateral needs to be X because the stocks went down. You basically are below X, so give us your securities. That's it." So you don't want to have something that can stop out your investment prematurely and shrink your time horizon. So there are different kinds of leverage, and I think that the kind of leverage that Buffett and Munger specifically talked about. They gave an example again of long-term capital management and how you have Nobel laureates, really smart guys, do really stupid things, and why? Well, first of all, they're kind of ivory tower guys they have this model and they think the model has to be right, and they're going to lever 30 to 1 and bet that it's going to be right. Well, the model is right vast majority of the time, but when it's wrong and you're so levered, you get wiped out, and they did. And so did their clients. So I think that there are prudent ways to have leverage like Buffett has, but by and large, for most investors, leverage, while it seems attractive in a bull market like we're in now, it's just trouble. You really, if you're skilled at what you do, you can add significant value without leverage. And while it seems like leverage can make a good thing great, what it can actually do is make a safe investment process that can compound your capital safely become risky. At least that's my view. So I don't use any recourse leverage in the portfolio because I just don't want to give up the time horizon, and I also don't want to take a chance on losing a lot of money just to reach for that extra unit of return. All right, number 5. So theme number 5 is something that maybe just even beyond investing, and that's how do we learn and evolve? And because I think if you were to point to one thing that Buffett has done better than most investors is how he evolved. I wrote an article for Forbes some time ago talking about how Buffett's investment process evolved over the decades. And it's amazing because, so I teach the value investing seminar, and as part of my reading program for that, we start with the partnership letters, and then we read the Berkshire letters, in the middle of the course. And it's amazing how the process evolves from a Graham-like, very statistical, cheapness-oriented approach to a much more nuanced approach based on business quality, to eventually appreciating compounders and reinvestment economics, and more of a Phil Fisher-like approach to value investing. So I think evolving is supremely important. And so here are a few quotes. So Warren Buffett said, "You should expand your circle of competence if you can, I have expanded mine a little over time, but you should be pretty cautious. I think he's being kind of falsely humble. He's expanded his more than a little, but I don't think he's kidding about the need to be cautious, because going back to some of the recent investors who think they're evolving by paying up 50 times earnings for really good fast growing businesses, maybe they're evolving, maybe their circle of competence is expanded, or maybe they're overconfident and they're going to lose a lot of money. Time will tell, and maybe there'll be some of each. I don't know, but I think that you should definitely change slowly. It takes a while to build competence in something, so don't assume in 6 to 12 months you can become a drastically different investor. That's just not how it works. The next quote, also from Buffett: if you want to grow your investment circle of competence, you want to read a lot and study a lot of businesses. It is more competitive now than it was when we started investing. But if you build your circle and have the discipline to be patient and do nothing, a lot of the time you can still do well. So I think that's important. I think that basically Munger, in a different quote, said, well, in the 60 years that we've been in Berkshire, if you pull out 30 best investments, basically, the remaining results are kind of not particularly amazing. And that works out to an average of one investment every 2 years, right? So the big hits are rare, right? And there's all this tendency and pressure to act. And here's Buffett sitting with 120 billion plus of float of extra capital he could invest, and his deputies investing in Amazon. He could invest, a lot of capital in Amazon tomorrow, but he doesn't, right? So I think he's patient. He's aware of his circle of competence, and he's aware about the boundaries. I think an earlier quote many years ago from him is, "The size of your circle of competence is not important, but knowing its boundaries is extremely important." So I think that's very important. Is you want to learn, and I think reading is great, studying is great, and applying that in practice is also important, because just reading is not enough. But I think that you want to expand your circle, but slowly. Third quote is from Munger, and it's amazing how much we learned over the years. If we hadn't, the results wouldn't have been anywhere near as good. We needed to improve at each step to take it to the new level. So again, I think there are plenty of investors who did well in the 60s or the 70s, and they plateaued, and they essentially ended up doing well, but not amazingly well, and we don't know who they are, or you don't know who they are, or the world has forgotten about them. And the richest and two of the richest people in the world, they got there by evolving and learning and understanding how, from first principles, to take their process to a new level. So very important. So there's a question in the chat: how does this compare with Munger's quote from Poor Charlie's Almanac from I think the IBM CEO? I am smart in spots and stay around those spots. So I think here's how I look at it. I think that at any given point in time, your circle of competence is fixed, right? You know well what you know well, and if you're at all unsure, then you don't know it well, right? And I'm gonna make it a little personal, and I'll give you an example. So I'm a beginning bonsai enthusiast. For those who don't know, bonsai are these little trees in pots, right? That are meant to look like giant trees in miniature. And I watched this master bonsai practitioner give courses and online lectures on bonsai and demonstrations. And one of the things that really stands out really well is sometimes he knows a lot. He studied with the Japanese master. His trees look amazing, and yet very frequently he gets asked something. He says, "You know what? I'm not sure, and I don't know, and I don't want to give you the wrong information. I'm going to see if I can find out from someone who knows that species of trees or that technique or whatever," right? So he's extremely confident, and yet he's very comfortable saying, "I don't know." So I think at any given point, you have to be very clear about what's in versus what's out as far as your circle of competence. And over time, I think you have to experiment, because I think, for instance, for me, I'm just not comfortable, paying very high valuations. I admit that it's possible that someone can do that well, but I get viscerally uncomfortable, and my ability to have behavioral comfort with my decisions diminishes if I start to say, well, my DCF says this business is worth 60 times earnings and I'm only paying 40 times earnings. It's just not something that I'm comfortable doing. So that's a structural thing. I just get visceral discomfort, and I have to listen to that, because you have to be behaviorally comfortable with your decisions. You can't do stuff where you don't feel full confidence, because the market's going to test you, and if you don't pass that test, you're going to make mistakes under pressure. On the other hand, there's stuff like domain expertise. Like I followed 15 different industries over the years, and for a while there were some that I thought I could learn, like energy. And then I realized I just really don't know how to value an energy company if the value depends on the long-term price of the commodity. And I've tried to do all kind of fundamental supply-demand analysis, but I just can't underwrite an energy business, so I pass. Right? So there's an iterative trial and error. So you do want to be, I think, as the Watson said, smart in spots, know what those spots are, but you want to test to see if you can get, maybe open up a new spot, but only after a lot of evidence that you actually have mastery do you want to count that as being within your circle of competence. And you also want to sometimes retreat from that. You want to say, well, I tried to bring something inside my circle of competence, but I really couldn't. By the way, if you guys want to, there's a great book out there by Josh Waitzkin, who's both a Tai Chi champion and a very strong chess master, called The Art of Learning. So it's The Art of Learning. And it's a great book about how do you actually learn? How do you irrespective of the domain? I think that's a very good book on the topic that's worth reading. All right, so so I think if I were to summarize the insights here, I would say learn from Buffett and Munger. Don't blindly imitate. So think from first principles. Always, always, always think from first principles. Figure out how to customize their insights to your own circumstances. You guys might be the next Warren Buffett, or you might be a busy business person who doesn't have time, to analyze businesses. Don't just do what they do. Think about your own circumstances and your own strengths or weaknesses. Be systematic. Like I really advise people, if you're going to invest, have a process. Write down that process. Share it with your stakeholders. That stakeholder might be your wife or your husband, or it might just be, it might be your clients if you're managing other people's money. But share that and commit that you're going to explain all your decisions in the context of that process, because that's one basic way of defending against behavioral biases. It's not the only way, but you really want to lean on process and avoid seat of the pants decision making. And finally, I think learning is super important. You got to keep learning. I've done this for 18 years, and I'm hoping that 18 years from now, I'm a far better investor, even though I feel pretty good about where I'm at now. I recognize there's so much more to learn, and I read a lot. I try to think a lot. I think about my own failures or my own mistakes. I seek out the mistakes and successes of others. Just keep doing that and iterate. So those would be my insights. So I think let's see. If you guys have any questions, please type them in. Have comments, or I want to hear what did you guys like from the meeting. I mean, there was a 6-hour meeting. I only scratched the surface as far as the material that I've covered. So what did you find interesting, or what questions did you have, or anything like that? By the way, disclaimers on the screen basically say don't sue me. I'm doing my best to be helpful. And then if you want to reach me, my email address is up on the screen. I'll also be very happy to share my owner's manual, which is where I outline my investment process that I've shared with my partners. But feel free to reach out if you're interested. So let's see what questions you have. So I'll give you guys a minute if you want to type in some questions, and basically, see what else you guys found interesting, or what you wanted to discuss. All right. Well, look, you guys are always free to email me. Check out. I have a YouTube channel where I try to post educational videos, and I'll be posting a replay of this one. They also publish occasional articles on behavioralvalueinvestor.com. So check it out. Probably once a month or so, sometimes twice a month. And always happy to be helpful. So please let me know. We have a question here. Do I think that long-term rates will stay manipulated down? I don't really know. I really don't. I don't really think about rates too much. I know that current rates are much lower than I think the long-term average is likely to be. I do believe that there'll be mean reversion. So I'm implicit in my valuation, I'm assuming we're not going to stay in an environment where 10-year treasury rates are 2.5 forever. But I don't have a view or timeline when that will change. Just I try to focus on microeconomics, and unfortunately, the macro stuff is not beyond me. We have another question. How do you determine your cost of capital in your investment process? So, so I think that, for me, I value businesses based on equity free cash flow, and I'm not willing to use a less than 10% discount rate. And some people might say, well, gee, that's too low. Why not in this interest rate environment use 7 or 8 or 9? I think there are arguments that can justify that, but essentially what you're saying is you're okay in locking yourself into what I think is a fairly low rate of return. So the underlying belief that I have is that we're going to see, much more fear in the market at some point in the future, and strong double-digit rate of return opportunities will manifest themselves. You just have to be patient, and the math is very forgiving. So if you do the math of doing nothing for 3 years, which is pretty extreme, right? You do nothing, you get cash returns, 0 to 2%, depending on the environment. And then after 3 years, you find a good investment at, say, low to mid-teens IRRs versus committing capital at 8-9% rates of returns, which is what's available right now. You're mathematically far better off waiting. And people don't fully appreciate that. You can wait for a very long time and still essentially end up being better off as long as those real bargains do come. And I believe they will. And why do I believe that? Because they always have. And human emotions, the stuff we saw in December, the sell-off, that's nothing. I mean, I invested through 2 downturns, and this is nothing, was nothing compared to either of those. So I think we're going to have a lot more fear in the market. I don't know when. I'm also not timing the market. I'm trying to have rigorous underwriting criteria, and if today or tomorrow a good business comes that meets my hurdle rates, I'll invest in it. So it's not about market timing. It's really about being disciplined and not committing capital at poor rates of return. So we have another question, and sorry if I missed this. How do I think the Kraft Heinz story plays out? Kraft is not something I know well. I think what Buffett talked about is that they're still a strong company, but the relevance of some of their brands is weakened. And in general, the balance of power has shifted a little bit away from the brand companies to retailers, especially with the presence of Amazon. But I think he also gave the example that Costco a few years back tried to get rid of Coke, of branded Coke, because maybe it was too expensive or whatnot, and had to reverse that decision because Coke was still too powerful a brand. So I think my conclusion, just to generalize, because I kind of want to stay away from individual stocks, is that I think the more marginal brands are going to get crushed, but the strong brands will still do quite well over time. So there was a question about autonomous cars. I don't recall if there was, and it's not an area of expertise, so unfortunately there's not much I can add on that. Would you, and then there was a question, would I have invested in Amazon? Is that not buying growth at a high price? So again, I want to stay away from stock recommendations because I don't think that's helpful to people in a public forum. But Amazon is not a company that I invested in. It's just, I think, outside my circle of competence, and that to me is the more important reason than anything else. So there was a question about security analysis seminar videos from Babson. I do teach at Babson. I don't record every class for various reasons. One is that you have to get permission from all the students. Two is you have to use a different classroom. And also, I don't want the students to all the time feel like they're on tape. I want them to be able to feel free and ask questions and just be more relaxed. So when I have the opportunity, I'll post more security and the value investing seminar videos in the YouTube channel, which, by the way, if you're interested in investing content that hopefully can help you make better decisions, please subscribe to get notified. But it's not going to be every single class. So there's another question of how do I handle it if I'm too early in investment? So I don't know what too early means. I'm probably too early in almost every investment because I joke with my friends or with myself, like sometimes every time I buy something, it goes down more in the next 3 months, which makes me think that maybe I should just automatically delay all my purchases by a fixed amount of time, which is not something I do. I'm kind of kidding. But sometimes, look, I think you have to use the market as a source of liquidity, right? So if you're going to let the market, which is essentially Joe and Blow trading 100 shares back and forth, as a source of truth, in the short term, you're in for a tough ride, right? You hopefully you underwrote the business, you're happy with the value, and what would you do if you bought a private business, right? You buy a private business, you buy a corner convenience store for a price you think will offer you good returns, and then you find out that two other guys traded a similar convenience store down the street at a lower price. Like, okay, maybe you feel like you should have waited, but that's like a silly thing to think. Like, you should really focus on is there has the value changed, and what's the price to value relationship, and what should you do as a function of that, plus the opportunity cost, of capital, right? So I don't worry about, kind of, I buy a stock and goes down. I have hurdle rates that they have very hard cutoffs for different quality businesses, and I think I have a video on my YouTube channel about that you can check out. And then I just make the decisions, and if and over time I monitor that, right? So if I'm wrong on the business and the thesis, let's say, is not playing out, then I'll adjust my value. That's different from, too early kind of implies you buy something and then the stock goes down further. That happens. It happens to a lot of value investors, and that's okay. And that's, by the way, one of the things that makes it tough to be a value investor. It's much more fun to buy Amazon, right? And or whatever. I'm not saying that that's not value investing, but again, I'm saying that it's much more fun to buy a stock where it keeps going up on you all the time, as opposed to have to wait through a period where others don't recognize your view of the business. So there was a question. So Warren Buffett said, "Ensuring different from building autonomous cars." Okay, so thank you for clarifying that. So any comments from Warren Buffett on their electric utility business? I don't recall what was said, but I believe he had asked Greg Abel to talk about some of the dynamics in Nevada where they were losing some market share, I believe, based on some legacy issues, but I'm not well versed in the details of that. All right, so we're getting close to the end of the hour. I don't see any other questions. So thank you, everyone, for participating. Really appreciate you tuning in. Again, you can see my contact information on screen if you have any questions. Please subscribe to the YouTube channel if you want to be updated when new videos are posted. And check out Behavioral Value Investor for regular articles on investing and behavioral finance. So with that, thank you guys, and hope to see you at the next seminar.